Did you know that the Indian government has completely transformed how charitable and religious trusts are taxed in 2025? If your trust or institution claims tax exemption, what you don't know about these changes could cost you lakhs in unexpected taxes. Whether you're a trustee, manager, or just curious about how these organizations work, stay with me for the next few minutes as I break down everything you need to know about trust taxation in 2025. I promise, by the end of this video, you'll understand these complex changes better than most tax professionals. Let's start with the fundamentals. In India, trusts and institutions formed for charitable or religious purposes can claim tax exemptions under the Income Tax Act, 1961. But here's the thing, the rules have significantly changed in 2025. Traditionally, there were two main regimes under which trusts could claim exemptions: Section 1023C for specific types of institutions, including educational and medical organizations, and Section 12A or 12AB for charitable and religious trusts and institutions. One of the biggest changes in 2025 is the merging of these two exemption frameworks. The Union Budget 2024-25 introduced this significant amendment to simplify tax regimes and enhance transparency for charitable organizations. The major 2025 changes you must know. The most critical update is that, from the assessment year 2025-26, the Section 1023C regime is being phased out, with organizations needing to transition to the Section 12A by 12AB framework. This means that if your trust was previously registered under Section 1023C, you'll need to apply for conversion to registration under Section 12AB. Here's what the transition looks like. If you had provisional approval under Section 1023C, valid until 2025-26, and you apply for regularization after October 1, 2024, you'll receive regular registration under Section 12AB. Your income tax return and audit report for AY 2025-26 must then be filed according to Section 12A or 12AB provisions. The sunset timeline for all organizations approved under Section 1023C will ultimately be AY 2029-30. Another major change, the Budget 2025 has proposed amendments to Section 12AB to exclude incomplete applications from being treated as specified violations. This offers significant relief to trusts and institutions who previously faced registration cancellation due to application issues. Registration process under Section 12AB in 2025. If you're establishing a new trust in 2025 or converting from Section 1023C, here's the streamlined registration process. File application in Form 10A at least 1 month before the commencement of the previous year from which you seek registration. For new registrations, you'll receive provisional registration valid for 3 years. For existing trusts under Section 12A converting to 12AB, your registration will be valid for 5 years. The Finance Bill 2025 has extended validity to 10 years for certain established trusts with proven track records. The registration application must include self-certified copy of the trust deed or society document, proof of charitable activities undertaken, self-attested copies of annual financial accounts, other supporting documents based on your specific case. Remember, during the application process, the principal commissioner or commissioner may call for documents or information to verify the genuineness of the activities of the trust as follows. Compliance with requirements under the Act, whether activities are being carried out according to the objects of the trust. Further, to continue enjoying tax exemption benefits in 2025, your trust must apply at least 85% of income for charitable or religious purposes. Maintain proper books of accounts if your income exceeds 2.5 lakh rupees. Get accounts audited by a chartered accountant. File income tax returns and audit reports within the prescribed due date. Also, ensure that income or property does not benefit any specific person, founder, trustee, or their relatives. What else? Yes, you should not modify your objectives without PCIT by CIT approval. And lastly, do not accumulate more than 15% of income for future use, except under specific provisions. For business activities, remember that receipts from business should not exceed 20% of the total receipts of the trust, otherwise exemptions will not be available for that financial year. Accumulation of income rules is updated for 2025. Section 11(2) deals with accumulation of income by charitable institutions and trusts. In 2025, you can retain up to 15% of income, without utilizing it in charitable activities, in the year it was generated. In case you need to accumulate additional income for specific projects, you can do so by filing Form 10 before the due date of filing returns. You must use such accumulated funds within 5 years, for the intended purpose. Failure to use accumulated funds, within the specified period, will result in them being taxed as income of the subsequent year. Let us now deal with tax return filing requirements. For assessment year 2025-26, the charitable trusts with income exceeding the basic exemption limit 2.5 lakh rupees must file ITR. The appropriate form is ITR 7 for trusts required to file under sections 139(4)(a) to 139(4)(f). Digital signature of the chartered accountant is mandatory if accounts are audited. Also, the due date typically falls on October 31st of the assessment year. What are the tax implications for non-compliance of laws year trust? If your trust violates any conditions in 2025, like income not applied for charitable purposes, will be taxed at the maximum marginal rate, MMR. Similarly, for violations of registration conditions, the entire income may become taxable and failure to file returns or get accounts audited can lead to loss of exemption. The 2025 changes to trust taxation represent a significant streamlining of the process, with the ultimate goal of creating a unified framework under Section 12(a)(1), 2(a)(b). While these changes bring clarity, they also require trusts and institutions to be vigilant about compliance. Remember these key takeaways. 1. If you're currently under Section 10(23)(c), plan your transition to Section 1(2)(a)(b). 2. Ensure timely renewal of registration, at least 6 months before expiry. 3. Maintain proper documentation of all charitable activities. 4. Follow the 85% application rule strictly. 5. File your returns on time with proper auditing. Trust taxation doesn't have to be confusing. With proper planning and compliance, your organization can continue its noble work while legitimately enjoying the tax benefits intended for charitable purposes. If you found this information valuable, don't keep it to yourself. Share this video with other trustees, managers, or anyone involved with charitable organizations. Hit that like button to help more people find this crucial information. And subscribe to the TaxWorry channel for more detailed tax guidance that breaks down complex concepts into easy to understand explanations. Drop your questions in the comments below. What specific aspects of trust taxation are you still confused about? I'll be responding personally to help clarify any doubts. Thank you for watching, and remember, staying informed is the best way to ensure your charitable organization continues to serve its purpose without unnecessary tax burdens.